Okay, good time then to talk about how the markets are poised ahead of that, all-important debate in Rajya Sabha. We've got two special guests joining in for that. S. Krishna Kumar of Sundaram Mutual and Sanctum Wealth Management's Prateek Pant is here with us as well. Gentlemen, both of you, thanks so much for taking time out for us. Krishna, let me begin by asking you, how much do you believe the positive and merits of the GST are already baked in right now?
Currently, if you look at the markets post Brexit and the kind of actions from the central banks across the world, I think we have seen a sea of liquidity and a scenario where the US Fed is probably not going to hike rates for quite some time to come. With surplus liquidity at low rates or negative rates, the overseas fund managers are looking at positive yields to invest into, and emerging markets offer such a great opportunity in this time frame. And India within that clearly is a very positive story for them. So a lot of the current valuations and current market position is driven by the strong inflow from ETFs, basically, mostly from the emerging market ETFs, and we've seen about 11 to 12,000 crores of buying in the cash markets from FIIs in the last 25 days. So that's basically driving the prices up, the markets up on one side. So the favorable monsoon progress, a kind of okay set of numbers from the quarterlies, and the GST that is expected to come through are definitely other positives which are driving the markets basically. But I would think that the markets right now are reacting more towards more to the foreign inflows, which is more liquidity driven rather than just the GST issue. So I would still think that GST is still not yet kind of baked into the expectations basically, because we're going to see GST happening after a year. So one would just look forward to a kind of a positive rub-off on markets, but would wait for the event to really unfold later on in the next fiscal.
Krishna, how susceptible are markets to a correction right now, and what could trigger that correction? Many say that the benefits of GST are in the price, and now the weak patch of earnings have started to come in. Global markets are also looking nervous. What are the thoughts or factors in your view which could accelerate selling here should we get a correction?
I think there's a global risk on trade that's happening, and as you said, that's kind of kept all the emerging markets up. So if you look at the current calendar year YTD, India is probably just about up about 10%, whereas you would see that a lot of other markets are up between 30 to 60%. So clearly I think we should look at the relative performance of various emerging markets when we look at what are the implications for India. And I think India, as we discussed on the show earlier, clearly has a lot more improved macro fundamentals at this point in time. It's got an inflation trajectory which is well under control and slipping down, interest rates further kind of easing. We have growth which is kind of looking up, and we have a clear reformist government which is trying to push through growth. So I think these are pretty strong tailwinds that India has on a standalone basis, and India in the next 5 years could as well become the third largest economy in the world if we continue to grow at more than 8-9% GDP growth. So I think there's a lot of fundamentals which point to India continuing to doing well. Short-term corrections will definitely happen, and it can be triggered by very strong data which can come from the US markets, which will hasten the Fed to take a rate hike decision that could kind of create certain volatility in the markets in the near term. The other issue from a risk perspective is the Brexit, the invoking of Article 50 happening earlier than expected, which could again open up some amount of uncertainty basically. But I think Brexit is a risk that is well understood by the markets now.
Prateek, how strong does the case look right now for Indian equity if one were to look beyond the immediate GST based market reaction or earnings? If one is talking about 4 to 6 quarters, what kind of returns CAGR can Indian markets or stocks generate in that period?
So, if I have to really look at, there are broadly 3 variables which would drive equity returns from here. You have the overarching earnings story, and how the earnings will continue to perform from here on. So while last few quarters we've been talking about earnings picking up, it's only now that we started seeing some of that percolate into actual delivery. So on earnings, I would say we will only start looking much better from here. On the other side, the liquidity triggers in a market which globally which is dominated by some of the sovereign $11 trillion of sovereign funds are actually giving you negative returns at this point of time. So clearly global markets are seeking yields, are seeking returns, and that's where India becomes a very attractive case for them. The only point of concern right now, as I mentioned earlier, was around valuations. With forward earnings of 18, with forward price to earnings of 18, there is little headroom which is there. So again, if I really was to look at some of the things which we've talked earlier, I think it's more going to be at stock specific level. It is going to be the actively managed fund space which will be able to still deliver in these type of markets. Quality growth is going to be rewarded, and we clearly see actively managed funds being able to deliver 15% type of CAGR over the next few years.
Krishna, let's talk about what's the crowning glory for you folks at Sundaram, and that's your small cap fund that's called Smile. Is it giving enough reason for you folks to be happy and cheerful? What's the performance they're looking like, given that you've actually seen a lot of the small and mid cap companies soar the charts? And also what's a 1 year forward growth estimate there?
Our mid-cap fund has a 25% earnings CAGR for the current year, a growth of 25% in the current year, and earnings CAGR of about 20-22% for the next couple of years. Our Smile fund, which is a small cap fund, has a much stronger earnings profile in the current year, while the micro cap funds would again be upwards of 20% from a earnings growth perspective. And we have just done a small study of the quarterly earnings thus far. If you look at which are mid and small caps which have declared results, about 343 of them in the small mid cap space, X of financials, clearly the earnings are trending up by about 13-14%, which is a pretty healthy kind of growth basically. So I think there is definitely improving growth outlook as you go down the cap curve. The benefits of lower leverage, falling interest costs, and efficiency gains are feeding through. So clearly we see that the lower end of the market continuing to chug along well with good earnings growth basically at this point in time.
What about, what's the sort of trend that's emerging when it comes to investments being made by just say, high net worth individuals or even corporates who do have a surplus to invest? Are they looking at equities? Are they even at this point hiking their exposure, given that, we've had quite a good run?
Yeah, that's a very interesting point. At different points of time, people have actually tried to book profit and see whether the markets have reached levels of being overstretched. I mean, we were just having a meeting with one of the fund managers who said he's increased his cash position about a month back, and now clearly is regretting the increased cash position which has been there. So it's a tough market. When you have liquidity driven rallies, it is always going to be tough to incrementally allocate to equities. We've always said that to a lot of our HNI clients, that it's never about timing the market, because very rarely can people get the timing right. It's always to be there in the asset class which can give you those type of returns, and the bigger loss will be that if you're not part of that asset class. So we continue to incrementally allocate into equities. Our clients are allocating into equities. However, at the same time, some of the hedging strategies are now becoming quite effective. So while you may allocate additional allocation into equities, but at the same time have adequate hedging strategies which can help you against any type of market events which may create volatility in the short term.
Krishna, final question to you then. Right now, last two trading sessions, including today, we saw that markets seem to be struggling to take out higher levels or even progress or maintain higher levels. Once the GST, as a factor is out of the way, many say already in the price, and earnings are also almost wound up, what will be the next triggers which the market would, look out for progressing higher?
I think there are a lot of things the government has been doing silently. The benefits of financial inclusion are still yet to play out. I think the rural economy is still not doing as well. So with better monsoons and also the benefits of the government's policy towards crop insurance, towards working on more projects on the rural side to create a lot more job opportunities, we will see that the rural economy, which has been weak for some time, is going to bounce back basically. This is definitely going to add to the consumption that we have seen across the urban markets. So consumption will continue to drive the economic growth for some time with the support of government-led infra projects. Probably into the next fiscal year, somewhere 12 months down the line, we will see that this starts to rub off onto the private corporate sector, which will then lead to a lot more capex starting to happen. So capex is probably 12 to 18 months away at this point in time on a private sector basis, and the consumption and the infra investments will drive the domestic growth story at this point in time.
Krishna and Prateek, both of you gentlemen, thank you so much for taking time out for us this evening here on Smart Markets. Let's in fact slip into a short break but come back and talk about how the government auditor, the CAG,